Silver touching $80 isn't a victory lap, and it isn't a meme moment either. It's more like a flare shot into the night sky, signaling that something underneath the surface is shifting fast and not quietly. When prices move this far this quickly, the number itself becomes almost meaningless unless you understand what's happening beneath it. And what's happening beneath it right now is the part most people aren't slowing down enough to really look at. Before getting into the data, let me clear something up. Because confusion around names always shows up when things start getting attention. This channel is Uncle John. If you hear anything else floating around that sounds similar, assume it's noise and keep moving. No courses, no signals, no private rooms, no paid access, just information, straight from primary sources, laid out so you can verify it yourself. That matters more now than ever, because markets like this create incentives for a lot of people to start selling certainty. Certainty is usually the first lie. Now let's talk about the actual structure of the silver market, because $80 didn't appear in a vacuum. The real pressure point isn't the headline price, it's the inventory that price is leaning on. Specifically, COMEX registered silver. That's the metal sitting in approved vaults that has warrants attached and can actually be delivered against futures contracts. Not theoretical ounces, not paper claims, but bars that can be handed over when someone stands for delivery. That registered number has been sliding steadily, and it now sits just over 88 million ounces. On its own, that number doesn't sound dramatic until you put it next to the obligations tied to it. March open interest, when converted into ounces, is hovering around 240 million. That gap between what's registered and what's promised is where the tension lives. It's not new, but the size and timing of it are what make this moment different. Every day, contracts either get rolled forward or closed out. That process bleeds off open interest, and as long as it happens at a fast enough pace, the system holds together. On Thursday, the roll rate came in around 30 million ounces for the day. That's the pace required to prevent March from becoming a problem. One day hitting that target is encouraging, but it's not a guarantee. This isn't a switch that flips once. It's a treadmill that has to keep moving. If that pace continues consistently, or if meaningful physical silver flows back into registered vaults, March clears without a crisis. If it doesn't, the math starts pointing toward registered inventories getting dangerously thin right around the end of February. That doesn't automatically mean fireworks on a specific date. It means stress, it means leverage meets reality, and markets don't like that feeling. What complicates things further is what's happening with February contracts. There are still roughly 200 contracts hanging around that haven't rolled and haven't closed. They're sticky. That's important. These are holders who, by their behavior, appear to be waiting for metal, not paper substitution. In a calm market, these clear quietly. The fact that they haven't tells you demand for physical delivery isn't theoretical right now. Someone wants bars, not exposure. Zoom out for a second, because context matters. Earlier this week, social media was loud with claims that silver was about to get crushed because China was offline for the Lunar New Year. The logic wasn't crazy. Holiday liquidity is thin, and thin liquidity is when large players can push prices around more easily. The window for that kind of move is real, and it's still technically open until China returns. But here's what actually happened. The March contract opened the week around $75. 5 trading days later, we're at 80. Volatility didn't explode, it compressed. The predicted slam didn't show up on schedule. That doesn't mean it can't still happen in the short term, but it does mean certainty in either direction is misplaced. Markets don't owe anyone validation of their timeline. There's been another story circulating too about mining companies realizing prices far above spot. Supposedly because the futures market is broken and buyers are paying massive premiums just to get metal. One company in particular became the centerpiece of that narrative. There is, however, a more mundane explanation that deserves attention. Many miners sell concentrate with pricing determined during a quotational period that can lag delivery by 1 to 3 months. In a sharply rising market, that lag can produce realized prices well above the spot level at the time of shipment. That explanation doesn't rule out tightness in the physical market. It just means the data point alone doesn't prove collapse. Both things can be partially true at the same time. Physical supply can be strained, and accounting mechanics can amplify how that strain appears in reported numbers. The mistake is pretending it has to be one or the other. Reality is usually messier. What isn't messy is the broader supply-demand picture. Silver has been running structural deficits for years. Industrial demand hasn't slowed, investment demand is waking up again, and mine supply hasn't magically expanded to meet it. Prices moving higher on that basis alone makes sense. The debate is about speed and volatility, not direction. Now look east. In Shanghai, spot silver is trading around $86, with futures closer to $88. That's roughly a $6 premium over Western markets. That gap exists as China prepares to reopen after the holiday. When buying resumes, it resumes into a market where inventories are already thin and nearby contracts are trading above deferred ones. That structure, known as backwardation, is the market's way of saying it wants metal now, not later. Commodities don't do that unless deliverable supply is tight. Step back even further and bring in the macro picture, because this week delivered a meaningful shift. Fourth quarter GDP came in well below expectations, around 1.4% instead of 3%. Final sales were even weaker. At the same time, core PCE inflation printed hotter than forecast, hitting 3%. That combination matters. Slowing growth with sticky inflation is the environment central banks hate most. It limits their flexibility and undermines confidence in paper assets. When growth falters but inflation doesn't, capital starts looking for things that don't depend on promises. Historically, that's when hard assets regain attention. This isn't theory. It's pattern recognition. You can pull the Bureau of Economic Analysis release yourself and see the numbers. They're not opinions. Add geopolitics to that mix, and the picture gets heavier. The United States has assembled a military presence in the Middle East that rivals levels last seen during major conflicts. Prediction markets now assign better than even odds to a U.S. strike on Iran before the end of March, with hundreds of millions of dollars backing that assessment. Oil has responded, and energy prices feed directly into inflation expectations. That loops right back into the metals thesis. People who've read books like Currency Wars understand this dynamic. Geopolitical fragmentation and financial stress don't move in isolation. They reinforce each other. Commodities become both tools and battlegrounds in that environment. There's another data point worth mentioning, not because it guarantees anything, but because it's unusual. In the gold options market, a large number of call contracts have been accumulated at strike prices that would require gold to triple by the end of the year. On their own, far out of the money options are often lottery tickets. Most expire worthless. What makes this notable is the timing. These positions were added even as gold pulled back from recent highs. Someone was willing to pay for extreme upside protection into uncertainty. That doesn't mean gold is going to $15,000 or $20,000. It means someone with capital thought that tail risk was underpriced. File that away as information, not prophecy. To keep this grounded, it's important to lay out the bearish possibilities too. Diplomatic breakthroughs can happen. A de-escalation in the Middle East would remove a chunk of the risk premium overnight. Weak growth could trigger broad liquidation across asset classes, dragging metals down temporarily with everything else. The COMEX roll pace could slow again. Chinese demand could return more cautiously than expected, and after a move like this, silver can absolutely consolidate or retrace without breaking the larger trend. None of those outcomes would negate the structural issues. They would just change the path price takes to express them. Managing risk means acknowledging that uncertainty is real, even when the long-term picture looks compelling. For those who read charts, and I want to be clear, this is education, not instruction, silver has cleared a previous resistance level around $79. That level mattered because it had capped price earlier. After breaking it, price reclaimed it during the early New York session. As long as silver holds above that reclaimed area, the structure favors continuation. On shorter time frames, former resistance has turned into support, and key moving averages are now sitting below price rather than above it. There is still overhead resistance in the low 80s. How price behaves there matters. Clean acceptance above that zone suggests strength. Prolonged hesitation inside it can sap momentum. Markets communicate through behavior, not predictions. So where does that leave us right now? COMEX registered silver continues to decline, and while the roll process hit its required pace recently, it has to keep doing so. February contract holders are still pressing for physical delivery. Shanghai is trading at a premium as China prepares to reopen. Macro data just confirmed an uncomfortable mix of slow growth and persistent inflation. Geopolitical risk now has a calendar attached to it, and silver is sitting at $80, a level that forces attention whether people want to give it or not. The real question isn't whether silver is bullish in the abstract. The question is whether physical inflows improve enough to relieve pressure before the next contract cycle, or whether the same deficit math carries forward into April. That answer won't come from headlines. It will come from daily vault reports and inventory changes. Those numbers are public. Anyone can check them. That's why this isn't about hype. It's about watching the variables that actually move the system. Price will do what it does. Your job is to understand why, not to cheer or panic. Verify the data. Stay skeptical of certainty. And remember that in markets like this, the most important moves usually start quietly before the crowd decides they understand what's happening.